Hi there, I'm Irk, and this is my channel, Get Irked. Is the bear market over, or will 2023 bring new lows for stocks? And how do you invest for either outcome? As we end what's been one of the most painful years in the stock market in over a decade, everyone's questioning about what we're going to see in 2023. Well, there are many out there who believe that there's a bullish outlook and that we might be able to see stocks rise through 2023. I'm not taking that angle at all. In fact, I'm actually quite bearish. For me, there are four main reasons that I'm not bullish about next year. The first is that the Fed won't pivot until 2024. Although some still say that we will see them pivot in 2023, if they end up doing it, it's because something serious has broken in the market. And that's not bullish either. Federal Reserve Chairman Jerome Powell has already told us that he wants to keep the benchmark interest rate above inflation, and then even raise it further so that it's restrictive. Even if you think inflation will drop from its 8% plus where it is now all the way down to 4%, that means that the current benchmark rate, which is at 4.25% to 5%, is where we'll need to be just to be at the inflation rate. In order to be restrictive, Powell will have to raise the rate above that. And a higher rate is absolutely not bullish for the stock market. Second, market analysts have not lowered their earnings for the S&P 500 in 2023. In other words, even though the S&P has sold off pretty well in 2022, without those earnings being reduced, it's still overvalued at these levels. When the analysts do start lowering earnings, we'll see stocks sell off to reflect that lesser value. Between China's rhetoric on Taiwan and Russia's invasion of Ukraine, the global concerns and heightened tensions that are affecting everyone are still there. And until those issues get resolved, that's not a good sign for the stock market. Finally, a recession in Europe is all but certain, and a recession is likely in the United States. Again, recessions are not good for the stock market, so expecting it to go higher is kind of a fool's errand at this point. So what would turn me bullish? Well, first, if China reopened its economy entirely and it stopped talking about Taiwan, or at least reduced the rhetoric, both of those would be very positive signs. Second, the war in Ukraine would need to end. Regardless of how it ends, it would just need to end. As long as we've got a hot war in Europe, there's pressure on the global economy and on stocks. Finally, if inflation drops more significantly and faster than anyone expects, then it would give the Fed the opportunity to both pause on their rate hikes and potentially cut rate hikes if inflation dropped low enough. But the likelihood of that happening is incredibly slim. So with my bearish view on stocks in 2023, how do you even go about investing for the long term? If you're a passive investor and you don't want to dedicate too much time to it, then you just dollar cost average. First, you start by finding a low-cost exchange-traded fund that tracks one of the major indexes like the S&P 500. Next, you'd figure out how much money do you want to invest over the course of the year. You take that lump sum divided by 52, the number of weeks in a year, and that's the amount that you put to work each week. You can pick a day of the week and just buy on that day, regardless of whether or not the asset is up or down, or you could be a little bit trickier and move what day you buy around based on whether or not that asset is up or down. Optimally, you'd like to buy on red days and sell on green days. So if you're talking about an exchange-traded fund that tracks the index, you'd want it to be pulling back on the day that you bought it. However, the absolute easiest way to invest is just to buy regardless of whether or not the asset is up or down. As the cliche goes, it's not timing the market, but time in the markets that matters. If you don't mind being a little bit more active when it comes to investing, you can take my approach. Now, I don't time the markets, but I do try to buy into weakness and take profits when it's going into strength. For this example, we'll take a look at Vanguard's total stock market index with the ticker symbol VTI. I prefer this exchange-traded fund to one that just tracks the S&P 500 because the S&P 500 only has the 500 biggest stocks in the S&P, whereas this one has all of the stocks that are in the US stock market. This means that in addition to the large cap stocks that you'd see in an S&P 500 fund, you're also going to see mid-sized companies as well as smaller companies called small caps. Since I'm going to assume that you already have an investment in VTI, then you're going to take that first step of deciding how much money you want to put into this investment over the course of the year. When we look at VTI in a chart, you can find levels where it might find support. This is the weekly chart, and you can see that we can find these lows of the week where the assets sold off, found support, and then bounced from those levels. So chances are there will be buyers who will buy at these levels again in the future if VTI pulls back that far. Since we're going to want to make a lot of buys throughout the course of the year, we're probably going to want to divide the quantity that we want to put to work by number of weeks, or whatever you want to do. Whereas for a passive investor who's dollar cost averaging in, there's no concern about whether or not they're going to be able to put their money to work over the course of the year. But when it comes to doing it this way, you might want to have a plan where you get a little bit more aggressive in case it looks like VTI isn't going to pull back. But when you're close to the beginning of the year, you have the entire year to work with to put money to work. So you can afford to be a little bit more conservative and wait for a pullback that fits your needs. In addition to drawing key levels of support, another approach you might take is to use Fibonacci retracement to also draw levels of support that other stock investors might be looking at. And you can see that this provides us even more levels of support where we might be able to schedule buys. For me, I always use limit orders, which means that I'm going to get the price that I'm asking for or better. I don't try to buy during the market hours on my own with a market order. I put my orders in advance. That way I can do my stock work either after my job during the week or on the weekends, and that way I don't have to worry about potentially missing that buying opportunity because I was busy working instead of being able to watch the assets move. How you choose to invest and be an active investor is of course entirely up to you, but for me, I have a few rules that make up my discipline that I follow very strictly. The first is that you always buy on red days and you always sell on green days. In other words, you never FOMO and buy into an asset as it's rallying, and you never panic and sell an asset when it's selling off. My second is that I like to buy near levels of support from the past, and you can see that these levels we've drawn regularly do find support in the past. If you're talking about selling, the opposite, you're going to want to find levels where it saw resistance in the past as well. And you can see that these do play out into the future. When an asset does rally, I do take profits. But my key approach is that I never buy all at once and I never sell all at once because I'm wrong. In fact, almost everybody is always wrong. You need to remember, you only rarely buy at the bottom and you only rarely sell at the top. Even the professionals don't do this. What you're looking for is to buy near the bottom or to sell near the top. Accordingly, since predictions are difficult, particularly when they're about the future, we don't know where an asset's going to go. So there's no point in going all in thinking that the bottom will hold only to have it sell off 50% from there, or to take profits in your entire position only to have it rally 20, 30, or 40% higher from where you took profit. Since there are no commissions anymore, you can afford to sell a single share at a time. So why not take profits slowly as an asset's rallying so that the majority of your position is increasing in value? In reverse, when it comes to adding to your position, instead of trying to predict where the bottom is, by adding in small quantities, you're ensuring that you still have cash on the sidelines in case something unexpected happens and the bottom falls out. If you liked this video, please hit like and subscribe, and I'll see you in the next video.